Ah, sweet. I've just seen a whole bunch of comments come through. So Robbie, Mark, hey, Creaser, long time. Afternoon, Kevin, Paul, and Mans. Right, yeah, let's get cracking. Here we go. We've got Clubhouse running as well. We've got Paul, Tommy, and Ross. Nice one. And Martin. Cool. Apologies for my appearance. I've just given up these days. Getting dressed, looking in the mirror. Who cares? So I actually went to the fish and chip shop the other day in my dressing gown, as in this, and my local Tesco's are where my onesie, and I think I'm like the village idiot. So yeah, rightio. So hopefully, who was here today? That was also in that mergers and acquisitions group chat at 11 o'clock. Anyone? Because this may not make sense if you weren't. There's definitely a lag going on here. Okay, we've got 2 hands up in the Clubhouse. Let's pop you. Okay, you both have the mics. We've got Paul and Kim. How's it going?
Hi.
Hey,
Hello.
Kim. How's it going?
Yes, good, thank you. I was in the room earlier.
Ah, nice.
Yes.
Was it helpful?
I was listening in.
Oh, was the chat helpful earlier?
Yeah, it was really good. I've joined the chat a couple of weeks now. I think Guy does it on a Friday morning.
Yeah.
I'm an M&A lawyer, so I'm familiar with mergers and acquisitions, but I'm looking to buy my own businesses. So I sort of found it really helpful for that.
Okay, nice. So, do you have any questions at all that I can help with, or anything to share?
No, I think the great thing with your input was that you do things differently to most. When you think of M&A,
yeah,
you know, you think of either a business and assets acquisition or buying the shares, the entire share capital, and you kind of just buy part of the business. So I think it'd just be good to hear more about how you do it. I mean, part of me was thinking you have quite a big setup in terms of systems that you can offer to a business, which obviously incentivizes them to sell a share of their business to you. And I wondered if there is a way, if you're new to this, would that work, do you think, or do you need to?
Yeah, definitely. Okay. Yeah, that's a really good question, actually. So, do you mind if I backtrack and explain my process first? Because there's probably some people here that
absolutely
haven't got a clue what Anora is. And then I was also running a Facebook Live earlier, and I had a couple of questions which I couldn't pop in there. So we've got Jason, Alex, your questions I will answer today. So for those that weren't in earlier today, I explained the way I go about M&A, which is, as Kim said, completely different to what most people do. So if you learn about M&A in, some sort of university or whatever, or hell, a book, they'll teach you traditional stuff like earn-ins, earn-outs, all that sort of stuff, management earn-in, all that sort of stuff. But I've basically made every error you can make with M&A. So I'm one of those weirdos that treat life like a video game. And my mantra is do, fail, learn, pivot. And I do that as fast as I freakingly can. Freakingly? That's a new word. Freakingly. I do it as fast as I can. So when I jumped into M&A around 2015, I was like, "Ooh, cool. Got a pot of money. Let's jump in and do things fast." And I made every mistake you can think of, like buying shit companies, buying good companies and then ruining the deal, doing bad deals on good companies, doing good deals on bad companies, like everything. Like there was one crazy acquisition I did back in, I think, 2016. I bought this satellite installation and home installation business. Okay, I mean, what was I doing in that business? I was really dicking about. I knew nothing about that world, and it was. I mean, that's beside the point. But what happened is, because my due diligence wasn't that good, I found out like a month in that this was a limited company operating from a personal bank account, and the bank account wasn't even in the director's name. So there was 2 blokes, let's call them, I'm not going to use their real names, I know, Tom and Dick. And let's say Dick was an actual dick, because he really was. Tom exited the business, and so he sold his shares to Dick, and Dick was the sole director. But the business was running off the personal bank account of Tom. And what happened is, like, 2 years passed. Tom didn't realise that this business was still running off his personal bank account, as in it was with his name on. And then when I got involved, I was like, "Can I see the bank statements, please?" And then I started seeing some discrepancies. I was like, "Who the hell is this Tom person?" And then I obviously contacted Tom, and he was flabbergasted because that Dick ran up a £20,000 overdraft and was hitting the red line, as in like the game over line. And so that was crazy. And then there was all sorts of other skeletons. So that was a business I really struggled to exit from. And so I guess the way I created my Nora method is just through pure losing money. I mean, there's no better learner than, putting your money where your mouth is and then it failing catastrophically. And so I just got bored of taking these 50 grand, 100 grand smacks to the face. And so I sort of combined my trading knowledge with M&A. So I've been a trader for about 16 years now. And trading is all about asymmetric risks, or asymmetric trades, where you have minimal downside, maximum upside. That's what I call an asymmetric trade setup. Or basically, we're looking for low risk, high probability outcome trades. And I thought there must be a way you can do that with M&A. And so I thought about call options. I was like, okay, that could be a way. So again, for those who are not familiar with the Nora, cheesy name, I call it Nora as in no risk acquisition. Obviously, there's no such thing as no risk, but you'll see why this is pretty much no risk, as risk-less as it can be. So let's say, I'm really not good at verbalizing stuff. I need a whiteboard. I'm good at doodling. But let's say that we have a company called Company X. And I'm going to use the same example as I did earlier, Kim. So let's say Company X was doing £10,000 per month profit, and I want to come on board. So what I basically offer is a £1 call option to buy 35% with a strike price of, say, 50k. Okay. Now I'm going to break this down so it doesn't sound so crazy. So first of all, let's talk about the strike price. So in an option, a strike price is basically the underlying value of this deal. So in this deal, let's say they're doing 10 grand a month profit, and I don't know, for all intents and purposes, due to the industry it's in, let's just say 35% of this business right now is worth 50 grand. Okay. So what I've done is I've paid £1 to have this call option. And what this means is that at any point over the next 2 years, I have the option to buy 35% of that company for 50k. Okay, that's all it means. Ignore the fancy terms, call options, etc. It just means at any point in the next 2 years, I can buy 35% of the business for 50 grand. I'm just locking in a price. It's a bit like putting a bid on eBay. Actually, no, it's not. So, but then I put some other clauses in place. So what happens is I normally put a doubling clause in, because I mean, with that first line, it doesn't seem that appealing to the seller. So what I say is, let's put a doubling clause in place. So I cannot exercise this option unless through my efforts, through my new systems and marketing and all that sort of stuff, we've grown the business from 10 grand a month to 20 grand a month. So now let's look at it from the seller's point of view. They're thinking, okay, so I get, in fact, let's backtrack a bit. There's one more thing to this. And what I also do to really offset the risk for me is that I parachute my marketing team in, or my marketing company in, and in my company, in that marketing company, we have an in-house web dev, graphic designer. Well, in fact, those two are the same person. Systems architect, all that, digimarketer, all that sort of stuff. And if you were to hire all of those people, like PAYE, etc., I mean, the salary is going to be like 15 grand a month. And so what I then say is, look, here's my team. You have unrestricted access to my team. You text them in the middle of the night, whatever. Use them. Create as many videos as you want, as many websites, landing page, whatever you want. Unrestricted access, and all it's going to take is £3,000 plus VAT per month. And with that, you'll also get me on board as well. So now what happens is that for the next 2 years, company X will be paying me £3,000 plus VAT per month for unrestricted use to my team. So it's a really good deal, because that's like, an expensive salary, and they're getting several people on board, and me every month. And I'll probably also say, once a month we'll have a 1 hour brainstorming session with you, blah blah blah. And so it's a good deal for them. And what this means is I can then come into the system, into the business, implement all my systems, everything that I think is going to grow the business. And if I do well, or it's in my interest that I grow the business, so you have to always align incentives. That's when conflict or bad things happen, when people have ulterior motives or different incentives, etc. I mean, the whole banking industry is so screwed up simply because of the incentives. It's just wrong. So what this means is I do whatever I think I can. I grow the business, and if I'm good, or if I do what I say I'm going to do, in 2 years' time, the business is doing more than 20 grand a month. At which point, if it is, let's say it is doing 20 grand a month, that means 35% of the business is now worth 100 grand. But I can come in and buy that 35% for 50k. But the reason it's zero risk is because that 50 grand doesn't come out of my pocket. Because don't forget, over a 2 year period, they're paying that retainer of 3 grand plus VAT per month, which is 72 grand. So of the 72 grand they've paid me, I simply just give back 50 grand, and I've got 35% of their business for free. Well, no, a quid, which is the price of the call option. So that's, I guess, the Nora in a nutshell. Now let's look at it from the vendor's point of view. So pros and cons. So let's say we do this, we get on board and we fall out because it's not going to work, I don't like the business, or he or she doesn't like me, yada yada yada. Well, no harm done, we just walk away. Like, let's say it happens in the first month. Okay, I walk away, I've still got the 3 grand in the retainer, so I haven't lost any money. In fact, I've made a little bit of money. All I've lost is really time. What has the business owner lost? Not much really. Yes, that company X owners pay 3 grand, but they would have also in that first month got a lot of friggin' work done, like all the brainstorming sessions, all the new stuff that my team would have built, etc. So that's and best case scenario, I grow the business a lot further. Like, I guess the best one I've done is, I won't say the name of the company, but when I got into the business, it was doing about, this is, I think, 2016 I did this. The business was doing about 25 grand a month revenue, and then 2 years later we hit £350,000 per month revenue. And this is where I had immense guilt, because the stuff that I did in that business, I was very active in the first few months, getting all the new client attraction journey through. And then that's all we did. So once it got set up, I completely changed their whole marketing sort of systems, etc. And then it revolutionized the business. But then after the first 3 months, I didn't really do much. I just drove down to the business every month. So there will be a bit of guilt. If you do things correctly, it sort of reminds me of the whole analogy of, big cruise liner breaks down off the coast. And they call in all sorts of engineering companies, and no one can do it, and all these engineering companies are, they're failing. And then before you know it, someone recommends this old bloke on a boat who pops over, and he looks around the ship, and then he just pulls out his tool bag with a hammer and just goes doing on the engine, and then all of a sudden the engine springs into life, 30 seconds work or whatever. And then the little fisherman goes out and invoices them for 10 grand. And then the captain goes, "What, 10 grand? You're here for 30 seconds. And then he itemizes the bill and goes, yes, 30 seconds worth, hammer, $1, 50 years worth of engineering knowledge, £9,999. It's that sort of analogy. Sorry if I've bastardized or ruined that analogy, but hopefully that makes sense. So in a nutshell, that's what the Nora is. So going back to what Kim said, how can you do this if you don't have the infrastructure? So believe it or not, I don't have that much infrastructure now. 2020 did slap me around the face, to be fair, and I've massively downsized a lot. And my marketing team is a lot smaller now. But going back to my first Nora, I didn't have a marketing company back then. It was just me. So all I did, like I did the same deal, but I just said, hey, just so you know, I'm gonna treat me as like a business mentor, and I'll charge $3,000 a month, etc. And I'll do all your Facebook ads. I'll build your landing pages because I can do that myself as well. I can build out all sorts of stuff. Here are my marketing metrics and the dashboard that we need. Because you'll be surprised how many businesses have zero clue about what key business metrics they actually need. And no, it's not revenue or profit or outgoings, etc. They are lagging indicators. All of those indicators show you of what happened last month or last year. What you need are leading indicators, things that will give you an indication of what's going to happen to your cash flow in a month or two, etc. So yeah, it's crucial that your business, first of all, you know what your leading indicators are. So is everyone happy with the Nora as a broad nutshell so far, before we go into some of the other bits and bobs? That I think is just the little overview. Now, so for Kim, said that she's an M&A lawyer, which is awesome. So you've got all sorts of knowledge, and no doubt. So here's the other thing. I'll put you in the mic just so we can bounce off each other. Here we go. So here's the thing. I bet when you're doing your M&A contracts, so your SPA, your sale and purchase agreement, your SHAG, the shareholders agreement, etc., I bet they are pages and pages and pages and pages. Well, the way that I do it, it's like no more than 2 pages long. That's it. The SPA is 2 pages long. The SHAG is probably 4, maybe 8 pages long, and it's all in simple English. So, and the beauty of this is I do zero due diligence now, 0. Whereas in the past, I spent months, sometimes months doing DD and like asking for the owner's inside leg measurement, and it's not conducive to it's like you're really trying to inspect a business owner and their business through a microscope whilst trying to keep rapport. It's incongruent, and I've known of businesses that have technically made the sale, yet due. What's the word? They've made the sale, but it doesn't go through unless it passes due diligence, which was like a 6-month process, and then it all broke down over those 6 months. Well, no shit, Sherlock. It's it's like, may I marry your daughter? Yes, you may. Okay, well, can you just send me all your bank statements, because I just want to double check that the family I'm marrying into is solid. It just doesn't make sense. So for you, Kim, if you're going to start getting into M&A yourself, you don't need a marketing team. You don't need whatever. You've got your core skills already, which is the legal side. Like, are you a solicitor or a paralegal?
Yes, I'm a solicitor.
Great. So you've had your 8 years of training or whatever. So the thing that you can leverage is your legal skills. So maybe you can work it to your advantage and target companies that have high legal costs. And then you can say, hey, look, I'm going to help grow your business as well, but as an aside, you're currently spending 10, 20 grand a month on legal costs. Well, pay me 3-5 grand a month and I'll do it all for you. So that's one thing you could do. I don't know what industry you want to get into. I mean, do you have an idea?
No, I mean, I'm also a property investor, so we manage our own portfolio at the moment. So as an easy sort of first one, I was thinking letting agents, because it would complement the business, and I know that a lot of letting agents are struggling at the moment.
Yeah.
But yeah, it's just an idea. I haven't really looked into it. So yeah.
Cool. But yeah, I think the DD thing is so important. It really is, because like I've walked into a business once and I walked out of that building with ownership of the company. Like, that's how quick some of these deals can go. Sometimes it'll be a week or two where you're bouncing through bits and bobs, but there have been times where I've literally walked in at 11 o'clock in the morning, and then I've walked out of that building about 7, 8 o'clock, and I've got 35% of the business. It's that quick, because you'll soon see during the process of getting in bed with each other whether you like each other, and so there really is zero risk. And also the added benefit to this is that you really do start orchestrating the whole business and controlling it. And let's say shit hits the fan. Let's say you do not deliver what you said you were going to do, and company X goes from 10 grand a month to 0. Maybe your fault, maybe not your fault. Doesn't really matter. And let's just say, I don't know, the worst thing that could possibly happen is, I don't know, downturn in your industry and the business goes bust. Well, guess what? The business will then wind up, yada yada yada. But is your name anywhere near that business officially? Nope. There's nowhere, because you're not a PSC, you're not a person of significant control, you're not a shareholder, you're at best an unofficial NED, which is a non-executive director, but your name isn't anywhere. And so it's great. Whereas, as I said earlier today, when I first got into M&A, I just went around trying to buy distressed businesses. And it's like trying to buy, it's like invest. Oh, I'm really bad with analogies. I was going to say it's like trying to invest in someone with, a terminal illness. So that's a really bad analogy. There must be a better one than that. But so,
can I just ask a question?
Yeah.
You obviously, this Nora strategy, you are only acquiring say 35% of the business. Is your end goal to own the whole of the business, or are you happy to own sort of minority shareholdings in multiple businesses? What's the end sort of goal for you?
So it is a great question, because there's sort of two answers to this. Now, it depends on the business. So there's the other thing which I forgot to mention, is that with Nora, it's not just one call option, it's two. The second one is like a Hail Mary call option. So, for example, let's say, going back to this example where company X is worth, 50 grand, or 35% is worth 50 grand. So, in fact, let's work that out. So, £50,000, divide that by 35 times 100. So, in this example, if 35% was worth 50k, that means 100% of the business is worth 142 grand, or call it round up, 143 grand. Okay. So, it's a small business, obviously. Now, so you do this call option, etc., and once you get to the point where they agree, yeah, we're gonna come on board, etc. No, the thing has stopped recording. Balls. Sorry, I'm holding a Facebook Live here. So 1 second, I'm gonna pause this for the moment. Sorry, Facebook Live. Can you all hear me still? Can you just pop in the chat box if you can hear? Balls. Sorry, hold that thought. The second call option, 1 second. Clubhouse, can you still hear me as well?
Yes.
Yes. Oh, thank God for that. Okay, so I've lost Facebook Live, I think. Okay, so yeah, the second call option is... My computer's going nuts. Sorry. So the business is worth 143k. And so you say, okay, do you mind if I add a second call option here? And they go, okay, well, what's it going to be? I said, well, let's say you had a magic wand, Mr. or Mrs. Business Owner. What would you like if, a billionaire was going to come here and buy you out for a life-changing amount of money, what would it be? And bear in mind, the business is worth, let's say, 142k. And if he goes, 500 grand, that would be amazing. Okay, well, the second call option will be, I would like to buy the remaining 65% of your business for 500 grand within 4 years. And so then, obviously, you work a figure out between you. And so, and if he agrees or she agrees, and it goes, well, okay, yeah, if you were to buy me out for 500 grand in 4 years' time, that would be an amazing deal, or 600 grand. Screw it, let's call it $1 million. Yeah, and so at this point, it's the second call option, which is actually a lot easier, because they're like, wait a minute, so you're gonna, you want this call option where you can buy my company for £1 million in 4 years' time, which is like 10x, or call it 8x from what we're talking about right now. And I go, yeah, why not? And then boom, you've got your second call option in. So here's the beauty of it. If you're really that confident in what you do, I mean, it makes sense, right? because that way, if you do really boom the business and then it goes nuts and it goes absolutely crazy, and then all of a sudden you can then buy effectively get the control of the rest of the business for a bargain. And the reason I came up with that second call option is because of the business that really exploded. Because on the business where I said where I grew the turnover, or we grew the turnover from 20k a month to 350 grand a month, if I had that second call option in place, I'd own 100% of that business right now, but I didn't. So this was sort of a hindsight. God damn it! I should have done this. So that's that. My computer's gone nuts. Literally. Oh well. So okay. So is that all cool, Kim?
Yeah, no, that's really helpful.
Sweet.
It's really, and I mean, you said that you don't have a lot of paperwork. Obviously, makes me nervous as a lawyer.
Yeah.
You said a couple of pages for a shareholders agreement, and I've not seen one for less than a couple of 100 pages.
No,
So
it's about eight
when
pages, under 8 pages.
Wow.
Yeah.
So do you just have a shareholders agreement and then 2 option agreements, and that's it basically?
We have an SPA, so the share sale purchase. In fact, yeah, 2. So,
Sorry, I meant share purchase agreement, not shareholder.
Yeah, we have that. We then have the shag, and that's it. And you have to understand, like, I've been through the ringer with all sorts of stuff like this, and this is me talking about the industry, not you, Kim, obviously. But I've lost all faith in the UK legal system completely, because I've been screwed over, even though I've been well in the right. And at the end of the day, what I've found out is that contracts are worth jack shit. Contracts are only worth something if you have the time, money, and inclination to enforce a contract. And so, to a point where, like, sometimes the time and money cost in enforcing a contract, even if you're in the right, is so extreme that it's just not worth doing. So, for example, I was in a deal once where I put 400 grand into a deal, and they owed me 800 grand, and like within 6 months. It was a crazy deal, but I had, it was an airtight, because it was such a crazy deal. It was a seed IPO investment where basically my 400 grand should have turned to 800 grand in 6 months. And I thought, this is too good to be true. And so I got an absolute airtight contract whereby if they did not execute the deal by the long stop date, as in within the 6 months, I can just bang out and get my 400 grand and run away. So for me being a trader going, this is one hell of an asymmetric trade here, because what's the downside? The downside, the guy doesn't deliver what he says, and I can bail and get my 400 grand back. So all it's cost me is 6 months worth of, lost opportunity cost. And what's the upside? 100%. I was like, okay, why not? Got an airtight contract. Guess what happened? 6 months later, no joy. Gave him benefit of the doubt another 6 months, no joy. Another year goes by, another year goes by, 5 years later, I get my 400 grand back. 5 years later, even though it was like the most airtight contract out there. I even had a QC look at it and went, yeah, like, you can take them to court and you're 100% win time, but it's going to cost you roughly 200 grand to get this enforced, especially if they play hardball. And that's just one example. I mean, I've got another one where I took someone to court where I was completely in the right. He owes me 40 grand. He pled poverty, and he's now paying, it's 40 grand plus costs, so it's like 50 grand or whatever. And he pled poverty, and so he has to pay 250 quid a month for the next 10,000 years. Yet, after 6 months of paying me, he stopped paying. So like the only thing I can do now is just force him into bankruptcy, and then I get nothing, definitely nothing. Like, so contracts are only worth, they're not worth much. And at the end of the day, if the relationship between you and your new business owner breaks down, no contract is gonna, it's game over. So it's all about the people at the end of the day. Like, the moment your relationship breaks down, it's game over, regardless what contract. So that's that. Okay, so I've got to move on to a slightly different topic now. We've been going for half an hour roughly, but in the last one we had a few questions that we couldn't answer because it was like so Jason, I'm glad you're here because I got your questions, and Alex Ristov, I don't know if you're here still, mate, but I'm going to answer your questions. So Jason Jones said, what was the oh, actually, sorry, one other thing, Kim, I forgot to answer your other question. So Kim, exit. So you're I'm all over the place here. That's why I'm not good with verbal stuff. I need like a whiteboard. You asked, what is my plan? Why 35%? So one, I don't like messing around with the ops of the business. So that's why I like the existing director there. The other thing is that I like having that second call option in case, we really do boom the business. That's one there. And then I get the whole business for cheapest chips. But the other one is that I like doing roll-ups. So you'll know what a roll-up is, Kim. But basically, let's say I've done a whole bunch of M&A around a certain niche, okay, and I'm going to use construction, okay. It's the easiest example. So let's say I've got a building company and I own 35% of a building company, and then I go and get 35% of a scaffolding company, then an electrician, then a plumbing company, then a architect company, etc. So before you know it, I've got my grubby little fingers in all sorts of different pots, and the outsider would say, oh yeah, Simon's got his business in a building firm and a plumbing firm, whatever, and they wouldn't connect the dots. However, if I were to then roll all of those businesses up into one topco, all of a sudden, who's the biggest shareholder in the topco? Me. And you now are no longer in a building company with a really shitty exit multiple. You now have a facilities management business with a far enlarged exit multiple, and I'm the biggest shareholder. Simply because when you do a roll-up, you roll up all of those companies into one topco, and what you'll see is that my 35% chunk of all the different companies, I'll be the single person with the biggest equity. So that is one. Does that make sense, Kim?
It does. Sorry.
Yeah, no worries. Yeah.
It does. Yes.
Cool. Oh, we've got a hand up here. 1 second. Who's this hand? We have Gavin. Oh, hey, Gavin. You were in here earlier today.
I need to jump off. I need to leave the room. But thank
no
you
worries,
so
Kim.
much for answering my questions, and I hope you do some more rooms.
Yeah. Every day, every weekday at 4 o'clock, I do a wealth generation chat here. So,
Oh, fab. Okay.
Yeah. Cool. Cheers, Kim.
Thank you.
Bye.
Hi, Sam.
Gavin,
Great
how's it going, mate?
Great. Just to build on that last point about the roll-up and the minority share. So
Yeah.
we've been thinking with my business partner on the same lines. In terms of getting that arbitrage on the multiple, is what we were effectively talking about, because from a consolidation point of view, they're all 35% holdings. There isn't a group. I understand from your point about you own the biggest shareholding, but you're the one that has shares in all of them to create a group, but you don't have control over any one of them. You're not got 51%. So I'm just trying to understand about how you actually can get that arbitrage on the multiple when you've only got a minority stake in each and every one.
Okay, so when you do a roll-ups, let's say you have one company. Okay, let's break this down. Oh, it was so much easier on a whiteboard, this. So let's say you had one company that is doing 100 grand EBITDAC. Okay, and that's the term I use now. So everyone's familiar with EBITDA, so earning before interest, tax, depreciation, amortization. I use EBITDAC, so it's earnings before interest, tax, depreciation, amortization, and coronavirus. Because there are so many good businesses that are now a crock of shit after lockdowns. So this is crucial, and you could be buying a dud where you look at all their last 3 years of accounts and it looks amazing. Like hell, you could be buying a travel company or a cinema right now, and their accounts look amazing. Would you buy it realistically right now? No. So EBITDAC is more important than EBITDA. So going back to the example, you have one business, the 100k EBITDAC. Let's say it's a 3 times exit multiple, so that business is worth 300k. Okay. Now, let's say you have another 2 businesses, identical in size. So you now have 3 businesses, they're all separate, worth 300k each. Now, if you were to roll up those 3 businesses into a topco, what happens is all the balance sheet, P&L, everything goes up into the topco. So now, topco, overnight, the moment you sign the papers, etc., is worth 900k. With me so far?
So even if there isn't a true group in terms of consolidated accounts with a subsidiary with more than 51% shareholding, you could actually roll them up into a topco.
Oh yeah,
so topco owns 35% in each of the individual companies below.
Okay, yeah, so you can't force anyone into this. So obviously, let's say I had 35% in those 3 businesses in that example. I couldn't just force it. I would have to, get a yes from the other directors, etc. But the reason I say you can have loads of control, even if you had held 10% of a company, is that if you have the correct drag and tag rights, the company can't do anything without your say so. So, I mean, I'm just thinking of another company I've got 35% of. Like, I have zero involvement in that. But due to the SHAG, the shareholders agreement, they cannot literally do anything without my say so. They can't get a $5,000 loan without me saying yes. They can't buy a certain amount of stock over a number without me saying yes. They can't hire certain key staff positions without me saying yes. So, although I don't own much, I have to say yes. And and you can be as stringent as you want with those drag and tag rights and those, special clauses, but some of them are quite strict, and it's only if I guess if I'm buying into a bit of a basket case, then yeah, I'll have pretty strict ones, but sometimes it's pretty laid back. But the cool thing with a roll up is, so now Topco is worth 900k, but because it's now a bigger business, you'll have a slightly better exit multiple. So it may go from 3 times to 4 times. So, and then with M&A, it's the age-old classic of 1 + 1 = 5, because you don't need 3 accounting firms. You can use 1. You don't need 3 blah. You don't need 3 receptionists. You don't need 3 whatever. And so there's you do streamline. Like, you may have to make a couple of staff redundant, and so all of a sudden, not only let's say you've done some very loose streamlining, you're probably worth you've saved $100,000 on the bottom line. Okay, so now the business is doing $1 million. It's now worth $1 million, but it's sorry, I'm getting confused here so those individual businesses were doing 100k EBITDAC. So Topco is doing 300k EBITDAC. Let's say you save $100,000 in costs, so it's now doing 400k EBITDAC. But now you have an uplift in the exit multiple. So let's say it's 4 times exit. So that means 400k times 4. Yeah. So now the business is worth 1.2. So 1.2 times 35%. So technically, you own 35% of Topco.
But key for that, though, to be able to do some of those cost savings and synergies, is the quality of your relationship with each of those 3 companies, so that they agree to your suggestions, because you can't force it.
True, and this is why I paint the bigger picture from day one. So if you're going to do that facilities management roll up, you say, hey, look, you're the building company here. At the moment, you have a shit exit multiple. I can get it so your exit multiple's ×7, blah blah blah. And the way that we're going to do this is we're going to team up with an architect, blah blah blah. And then you can then sort of show them that's the plan. And so when the time comes, they're ready for it. But here's the thing.
Yeah, that's really interesting, because I have the example, actually, and I've spoken to a couple of other people. There's when we've laid out the bigger vision of what could be achieved and talked about the arbitrage that can achieve on the multiple and the synergies, etc., and showed run some numbers by them about the size of the prize over a 3 to 5 year period. In 2 occasions, it's intimidated and put them off the deal. It's just, oh no, we're all right, as we are.
Yeah.
So I think you've got to be able to read that really carefully as to whether you actually just do it incrementally with them to get them on board and gradually roll out the vision, or if they are a bit more forward thinking, you think, actually, I think they would be really enticed by that bigger vision.
Yeah, so I don't really spend too much time. I just say, look, this is the goal, but I mean, it's so far in the future, and we're only going to do that in 5 years' time if we're still in bed together and we're now business husband and wife or whatever, and business is doing really well. And let's say, fast forward, you're trying to do this roll up, and only 2 of the businesses want to roll up, and the third one goes, nah, it's too scary, don't want it. and let's say it's a scaffolding company, then go, okay, no worries, I'm just going to go out and buy a scaffolding company and find someone else for the roll up then. And then
Yeah, sure.
and then before you know, or you go and entertain 5 other scaffolding companies and see who wants it most. So yeah. Now hopefully that makes sense. Now I must answer these questions. So Jason, sorry mate. So Jason has asked, what was the decision that took you from running your own business to looking into doing M&A? And it is a really good question. So for me, it's not a and or thing. It's like it's a natural progression. So I guess the wealth generation journey I went through, I've had a couple of slaps in the face. So the first one is when I started getting into sort of wealth gen, and I read Rich Dad Poor Dad and The Richest Man in Babylon and all that sort of stuff. And I realised, holy shit, if I want to earn 50 grand a month take home, I'm never going to do that in a job. I have to do it via business. So that's why I got into business, etc. So the first slap was I must own my own future. That's the first slap. The second slap is then I looked at all the world's richest people, etc., and gone, how did they make money? Like Warren Buffett, everyone thinks he's a stock picker. Wrong. Warren Buffett is probably one of the world's most prolific mergers and acquisitions practitioners. He doesn't do stock picking like people think he does. He buys actual businesses. He's made his billions through M&A. And then I realised, okay, so big wealth is done, yes, in the business world, but it's done via M&A. Because if you take a business that wants to go from 1 mil turnover to 10 mil turnover, let's say it takes 10, 20 years to get there. Well, why don't I just go out and buy 10 companies that have a mil turnover? Yeah, and I just have a bigger chunk or even a small chunk in Topco, and I can do that very quickly. So for me, it's just the natural evolution of being a business owner. And the full cycle of business is set up, run, grow, and sell. That is the full cycle. Set up, run, grow, sell. Whereas most people do set up, run, and they run forever. I mean, take my dad. I love my dad to bits, obviously. He's my dad. But he's been in business for 35 years, and he did extraordinarily well for the first 2 years. But he then plateaued for the next 33 years, if that makes sense. Like, his revenue hasn't grown. In fact, it's probably diminished every single year for the last 30 odd years. So, and I just didn't want that to happen. Like, stagnation for me is mental death. I do not let any day pass by without me learning something new. And for me, M&A is just a natural progression of business. And so I was like, okay, how do I've set up a business, I'm growing it, I'm sort of running it, how do I businesses? But ultimately, like, I don't know whether it was you, Gavin, earlier you said, or someone else said, yeah, you start small. And I 100% agree. So for me, I have always been playing the 5 to 9 game. Set up, run, grow, and sell a business with 5 figures. And then go, cool, I've learned all these new cool lessons and learning points. Sweet. Okay, now I'm going to set up, run, grow, and sell a business for 6 figures. And then 7 figures and 8 figures. And every time you go through the full cycle, you've learned a shitload. You've learned loads. Like, I've only been in business 10 years, but I'm pretty sure I've been through the ringer a lot more than people that have been in business for 30 years. Like, I've been screwed over so many times, it's ridiculous. I've had staff that stole money from me and other staff members. I've had business partners that have stolen money from me. I remember there's one business partner that stole £75,000 from me, and then started using my money to pay her legal fees when I was pursuing her. Like, and it was ridiculous. And there's so many things that have gone wrong. I've bought so many businesses with like skeletons in their closet, and I'm like, Jesus Christ, did you honestly think I wouldn't find out about this massive, contagious elephant in the room? But it's all fun. It's just a video game, and like in the video game, when you fail or die, you just hit reset and then give it a go and you do something slightly different. That's all business is. You just got to get massively over that fear part. So for me, M&A is the way forward, mate, if you want some big progression in your business. So the other question you had, Jason, I think is it cheaper to buy revenue? Oh no, it's sorry. The other question, I think, is from Alex Hristov, and he said, "Is it cheaper to buy revenue, i.e., buying out a competitor, or grow it internally?" Well, the answer to that question is simply capital. It is a capital arbitrage question. So you have to fully understand your CPA, your cost per acquisition, as in how much does it cost you to get a customer. So for me, I don't like looking at revenue. For me, it's just profit. I don't give a shit about revenue. I want divvies. So when I buy a business, I want divvies. I don't want to be a sandbag. And again, I've been a sandbag in so many businesses that it's ridiculous. And what I mean by sandbag is that I buy a chunk of money in a business, and the business is now not profitable, doesn't want to sell, and it isn't paying dividends. So what are you? You're just a fancy shareholder with yes, you own a chunk of the company, but it's giving you nothing, no benefits, no divvies, no exit. You're a sandbag, and you're just giving that company money. As I said, I stupidly went against my own rules, and I did not do a Nora. And a week before the first lockdown in March, I blew 50 grand on, how much did I buy? I can't remember. It wasn't 35%. It was more than that. But I basically just lobbed 50 grand to someone for a chunk of the business. Lockdown happened. I was like, shit. So guess what? I'm a sandbag because the business isn't selling anytime soon, and it's not making any profit. So that's 50 grand down the drain. It'll probably come back in a few years, but yeah, it's opportunity cost. I mean, I could have put that 50 grand in Ether and made 400%. Yeah, so going back to your question, is it cheaper to buy revenue or grow it internally? Well, you have to figure out the numbers. So let's say if you... this is where you really do need to draw out some numbers. But let's say if you were to grow your business naturally, or via your own internally, growing it normally, and let's say it costs £100 to get a new customer. Okay, you got that benchmark. Now you can then go and look at your competitors or other businesses in that field and say, right, how much is it going to cost me to buy this business? And are the overall figures cheaper or more expensive than £100 per customer? And then it's simply an arbitrage thing. So yes, if your competitor is so sometimes you can actually get a lot more profit just by buying out. But the thing is, if you just buy your competitor, like one business, you don't really get that much of an exit multiple uplift. So let's say there's you on your own and you've got a 3 times exit multiple. If you then buy another business of a similar size, yeah, the business is doubled in profit and turnover, etc., and a little bit more. Remember, 1 + 1 = 5 with M&A. But is your exit multiple any better? Probably not. So you really only start seeing exit multiple uplifts when you start, when the revenue or the profit is 5x or 10x, etc. So if you're going to go out and buying a bunch of different people, you may as well just go and do a Nora and buy five other companies at the same time, and before you know it, you've got this massive potential roll up. So yeah, I mean, there's too many variables, but that's hopefully just one quick answer to that. Alex, your other question was, when should you consider deals which include real estate, e.g. businesses that own their warehouse, office, studio, etc.? Now, I'm not in property. I've never been a fan of property, simply due to the return on capital invested, return on time invested is just below my threshold. It just is not that good. And for me, it's just sticky. Property is an illiquid asset, etc. So this is my personal preference. I'll ask Gavin what his preference is in a sec. But my personal preference is that if there's a business that owns its own building, I will spin out that property. I don't want any involvement of the business in the property. Yes, that property may have equity and blah, blah, blah. But what I'd highly encourage is that... no, I'm not going to encourage anything. This is just what my opinion. I would personally... separate the two businesses. So I will buy the business. It's a nice, clean, easy deal, and the property will then go into another business which the director owns. And the business that I've just bought will just simply just pay a rental or a lease, and that way the existing business owner, will still get that rental, from his property, etc. So technically, I'll then be buying a business and also a landlord, which also has its old stickiness. But I mean, Gavin, what are your thoughts, mate?
Hi, yeah, sorry, I struggling to mute there. Tom, completely agree that if you can, I've often put into a separate business the property component, then you've got an asset base of which you can leverage finance.
True.
I interviewed James Sinclair earlier this week from a podcast, and he had this really neat idea way of thinking about you should be running 4 companies concurrently. He was saying you should be the company you are today is number 1. Number 2, the company you really want to be. That's the aspiration you're always working for. Number 3, a media and marketing company because you're driving the traffic to drive the sales. And then 4, a property stroke investment company. But the interesting thing is that when you have times of challenge, like many businesses are experiencing now, if you've got assets in another business or in the property portfolio, you can leverage in terms of raising finance on those.
Exactly.
And if you have done, as many people have done, bought businesses and then just done a sale of the asset and just kept the core business. Because one of the questions that used to be in boardrooms and in strategy conversation is, what's our core business? Well, our core business is retail, for example. So therefore, we're not a landlord? We don't need to own the property. We don't need to own the asset of the property. But actually, I think that's now coming to the fore when you see the likes of Debenhams et al. Struggling with the rent from the high street. That actually, if they'd had that asset of the property, they would have had a fallback of being able to leverage that asset to raise funding.
Exactly. Yeah, it is a valid point. Yeah, agreed. So are there any other questions here? Because I've got dinner in 7 minutes. So I'm going to have to cut this short. But are there any quick questions that I can answer in a couple of minutes? Otherwise, I've got to run downstairs and have dinner and put the kids to bed. Any other questions on Facebook Live? Any questions? I'm going to give it 10 seconds for someone to pop their hand up or ask a question. No. Okay, well, what I'll do is I'll finish off with this closing sort of idea or thing, thought, prodder, is that if someone's listening to this and also this morning and thinking, oh my God, I need to get into M&A, I'm missing out on a trick here, I would urge you not to rush into it without doing a fair bit of sort of due diligence, obviously. And the question you need to really consider is the barrier to entry. Like, do I really need to buy an existing business, or is the barrier to entry so low that I can literally just set up from scratch myself? Now, obviously, there's a million different variables and answers to this, and every sector is going to be different. But sometimes you may not necessarily want to go and buy an incumbent business that's doing things the wrong way. You could just set up one from scratch with none of the skeletons, none of the drawbacks, etc. And at the end of the day, when you're buying a business like that, like, you're really just buying their list. And then you need profit clawbacks because, if you buy a business and then, all the clients run away because they're only clients of that business because they're like the old director, then shit. So you then need profit clawbacks, for every pound that of profit misrepresented, I can claw back £2 off the asking price or something like that. There's so many different variables, and that's why I like M&A, because there's no rule book. And like, this is why when people say, do you have any good books to read? And I'm like, I've never read an M&A book. I probably never will, because it's far too fluid. It's far too fluid, and you can always come to an agreement. Whatever, there's always a happy. Not necessarily a win-win. I think they're two different things, win-win situations and happy situations, because I've been in winning situations and been very unhappy, and vice versa, no doubt. So for me, I prefer a happy win, happy outcome. So that's about it. Liam's just said, are you running any trading crypto courses currently? I've sent some colleagues your way. So I send them to therealistictrader.com. And they can have 2 months access for free to our community, and they get 20 hours of stuff. So, therealistictrader.com. But for anyone listening, please check out thewap.org. That's like my wealth generation business, and we talk about everything, like business, investing, all that sort of stuff. Anywho, my kids are now calling me. I've got to love you and leave you. I'm going to be back here at 4 o'clock Monday. So every weekday at 4 o'clock, I hold these Wealth Gen chats. Gavin, Kim, thank you so much for your contributions today, and also those on Facebook. So, lovely meeting you, Gavin. It's been good.
Likewise, we'll speak again, no doubt.
Toodles, everyone.
Bye.
Bye bye.